This is the Asia Trade. I'm Shery in Tokyo.
And I'm Paul Allen in Sydney. The top stories this hour. A positive open ahead for Asia after tech drives Wall Street to fresh record highs. The Philadelphia Fed president backing the case for one rate cut later this year. Australia's central bank set to keep bonds under pressure. A hawkish hold expected today in line with sticky inflation. Plus, activist proposals hit a record high for Japan's AGM season. Toyota's chairman set to get a grilling from investors on concerns about oversight and governance. And let's get to today's agenda. And Shery, both the Chinese Premier and I have left Canberra. I'm back in Sydney, obviously, but Li Qiang is off to Perth. He's got a busy day ahead of him. He's going to be visiting a lithium mine, also Fortescue's hydrogen project, a number of business meetings. Li is seeking now greater access to Australian critical minerals. So that could be another potential point of tension between Australia and China going forward. More presently, though, we are closely watching today's Reserve Bank of Australia decision. We're expected to see the bank stay on hold, Shery, of course, at 4.35%. That'll be 5 meetings in a row now. But it's the language we're really going to be watching because Michelle Bullock, the governor, has been quite equivocal on the path ahead from here. I mean, there is a slim chance the next move could be up. So today's press conference going to be one to watch.
Yeah, and that higher for longer narrative perhaps also reflected at the Federal Reserve, right? We heard from the Philadelphia Fed president talking about needing several more months of improving inflation. Take a listen.
I have a forecast for inflation, employment, and economic activity, slowing but above trend growth, a modest rise in the unemployment rate, and a long glide back to target for inflation. If all of that happens to be as forecasted, I think one rate cut could be appropriate by year end.
Still, the narrative is that we will eventually, even if delayed, get to that rate cut, right? So not surprising, we are seeing markets supported. We're seeing improved corporate earnings. We're seeing reined in inflation, not to mention the exuberance over artificial intelligence. And you get 30 record highs for the S&P 500 this year. The NASDAQ 100 also very close to that 20,000 level in the New York session. And we have seen that risk on sentiment filter back into the markets. Treasuries falling. We also had more than $20 billion of corporate bond sales, and oil prices again above that $80 a barrel for the first time this year on that improved risk on sentiment. And this is a setup across Asia because we have seen that pressure, especially coming from the volatility emanating from the European chaos that we're seeing politically, the French election. So we had Nikkei stocks seeing the worst day since April. We're seeing upside of 0.1% when it comes to the setup for the open. Sydney futures also higher by 0.4%, as we're watching, of course, the offshore yuan and that bag of mixed data that we got from China. But Paul, of course, China very important for the Australian economy as well. And when it comes to today's session, all eyes on the RBA.
That's right. We typically get some commentary from the RBA on what's going on in China, and let's talk more about that upcoming decision later this afternoon. Economics reporter Swati Pandey joins us now. And Swati, of course, we're not really expecting any change, but as I mentioned there, the governor has been really on the fence about where the next move might be, right, hasn't she?
Yes, she is keeping her options open, and this year in particular, the RBA has tried to keep a hawkish stance. So when we have asked them in press conferences several times, do you have a neutral bias or do you have a hawkish bias? And Michelle Bullock has refused to answer that question straight off. So they really do want to keep their options open. If inflation continues to stay up but also starts moving in the wrong direction, they do want to keep that option to hike, and they have warned about that as well. They have said they will not hesitate to hike if that does happen.
So you talked about sticky inflation, but what about the state of the economy? What are some of the factors that will really guide that decision, not only for this meeting, but for future meetings as well?
Look, the Governor, Michelle Bullock, and her new deputy, Andrew Hauser, who has recently spoken for the first time, they have both said repeatedly that inflation is their predominant challenge. So that is what they are really keeping a very, very close eye on. At the same time, we are seeing that the economy has slowed down a lot. So since the second half of 2023, the first quarter of 2024, all of this period has been marked by a slowing growth, a slowdown in retail consumption, downbeat consumer sentiment. At the same time, labor market is really strong. And that is what is giving the RBA confidence that it can engineer a soft landing. It can maybe hike one more time if inflation is going in the wrong direction and still be able to preserve that labor market gains.
Just quickly, Swati, in a couple of weeks, we're all getting a tax cut. Has the governor had anything to say about the inflationary risk about that?
Yes, so rate cuts and also $300 electricity rebate that the 10.4 million roughly households will get from July 1. The Treasurer's forecast, the Treasury's forecast is pointing to headline inflation coming back to the band. And when Governor Michelle Bullock was asked about it, she did say that she would agree with that forecast. However, they look at underlying inflation, the core inflation, and she said she did not expect a material impact on inflation or economic growth. In fact, she does not expect people to spend that extra money either.
Economics reporter Swati Pandey there with all eyes on the RBA as we get that rate decision later today. And of course, markets will be watching that one closely as well, as that perhaps higher for longer narrative continues across the world. But that's not deterring markets from reacting because, of course, we have seen that huge rally when it comes to the U.S. S&P 500, and we're talking about a 30th record high that sent the S&P 500 above that 5470 and a gain of 15% year to date. But let's discuss with our next guest because he does expect a correction in the coming months. Andrew Simmons is Senior Portfolio Manager at Morgan Stanley Investment Management and joins us from New York. Andrew, great to have you with us. Is this because you're worried about also the breadth of this rally? I mean, it's been just a few stocks concentrated in tech, the artificial intelligence exuberance that has sent markets higher.
Boy, is that not true. I think I'm more worried about the fact that the market's up 40% since the October low. The market's gone up 7 out of 8 months in a row, and we're coming up to summer here. And historically, the first 2 weeks of July are very good for markets. Then we have second quarter earnings season. And then we move into August when a lot of people go on vacation. Liquidity dries up. There's not as much corporate news. And that's when stock market tends to get more volatile. So you tell me the narrative that will cause that volatility, but I suspect later into summer we'll get more volatility. And it makes sense because the market is up so much in such a short period of time. So I am a little anxious post-earnings. I do think second quarter earnings are going to be very strong, but we're due for some type of more than 5% pullback we got in the March-April timeframe.
Are you expecting more broadening in this rally, especially around the AI narrative, but perhaps some other companies that are also influenced by this rally and this exuberance?
Yeah, so look, what's happened, I think, is there's been a little bit of maybe the economy is slowing fear trade over the last few weeks. And so you've seen some of the cyclical stocks trade lower. And if you think, oh, gosh, economy is slowing, the one area that probably sails through it is all the AI stocks. So that's why I think the narrowness is there. But I wouldn't sell some of the cyclical stocks short because I think when we get into earnings season, I think the banks are going to report very good numbers. Some of the insurance companies and the asset management firms. I think the industrials because of fiscal policy. So I think there are plenty of other areas that actually, when they get to reporting earnings, it's going to come in pretty strong. So I don't worry as much about narrowness of breadth, and I'll tell you exactly why. If I look at the companies that have had the best earnings revisions, in other words, the companies have had the best fundamentals, it is an AI, right? It is. So these stock prices aren't just going up on hopium. They're going up on very, very strong fundamentals. And that's a good setup for stocks. When companies that are doing the best fundamentally happen to be the best performer stock price, that's the greatest combination.
Andrew, some of these big names have obviously captured a lot of the headline space and a lot of the oxygen, the likes of NVIDIA, Microsoft, etc. But the AI story is obviously bigger than that. Somebody's got to build these data centers. They're very energy hungry as well. Do you see other opportunities, perhaps down the chain a little bit, that haven't been looked at as closely?
Yeah, I did. It's an interesting question because a lot of money ran into utilities with the thought that, there's going to be this massive energy consumption, and therefore you should buy utilities because they're going to be the big beneficiaries. Except they're still utilities, and the data center consumption down the road isn't here today, and these stocks have had big moves up on this expectation. But I don't think it's there yet. And, I'm dating myself, but I remember when the search function first came out, it was Ask Jeeves and Netscape and Yahoo, and ultimately Google won. So I'm very wary of trying to pick winners and losers. I know who's got the best chips. I know who makes the best chips. I'll stick with the picks and shovels today and let things fall out where they are. But I do think sometimes people look away from the obvious and they try to buy the less obvious, and that's unclear who that is right now.
In terms of the obvious big names have also been mainly US listed as well. But when you're looking to broaden your search, what's your allocation towards Asia?
Well, we have some in Asia. I run a global fund. I'm agnostic. I just want to figure out what will be the best way to outperform our benchmark MSCI World. And at the end of the day, the U.S. has been the best performing market and has the strongest earnings revisions. And so we don't have a lot. We have about 10% in Asia. We have another 8% in Japan. But I'm not a dedicated, emerging markets manager. I'm a global manager. I'm looking for the best opportunities, rest in Europe. I am intrigued. The one thing I will say about Japan that intrigues me, this is actually coming from the kind of the incoming inquiries we're getting, is that with inflation bubbling up, a lot of pension money that's been mostly allocated to fixed income's got to find a home in higher returning asset classes. So I think there will be money that goes into Japanese equities. And so I think we'll be increasing our allocation. But I think the trade to move out of the U.S. and into other parts of the world, that has not been successful year to date. And I don't think it will the rest of the year, simply as I said before, which is I see the best, really, earnings revisions coming in the U.S.
All right, Andrew Su-Lin, Senior Portfolio Manager at Morgan Stanley Investment Management. Thanks so much for joining us today. And coming up later on today, we will speak exclusively to the Bank of Thailand governor about his outlook for the nation's economy and political pressure for an interest rate cut. That conversation coming up at 11 a.m. Hong Kong time. That's 1 p.m. if you're watching in Sydney. But before that, on the Asia trade, we will preview today's RBA decision with RBC Capital Markets. They're expecting Australia's central bank to stay on hold. UBS joins us to discuss their investment strategy and why it's time to put cash to work. And Kearney China shares their view on the consumer recovery as the 618 shopping festival wraps up.
You're watching the Asia trade. China has launched an anti-dumping investigation into pork imports from the EU in the latest escalation of trade tensions between Beijing and Brussels. For more, our China correspondent Min Min Lo joins us now. And Min Min, this is a very targeted measure, though.
Yeah, it is, and it has been a long time coming. We've been hearing rumblings of potential tit-for-tat levies that China could impose. That's been published all over Chinese media, and it looks like now the government has finally announced that they will be launching this anti-dumping probe into pork imports. Now, this is going to affect countries like Spain, Netherlands as well. They are the big exporters of pork to China. It's a $1.8 billion industry. It sounds like a lot, but if you pull back a little bit and look at the overall EU-China trade, that stands at $280 billion. So this really represents just under 1% of trade between China and the EU. So it is indeed, all things considered, a very carefully calibrated response. China really remaining cautious here about not overstepping when it comes to retaliation, because the last thing that China would want is for the EU and the US to draw closer together when it comes to their anti-China stance. And so the bigger question here is whether this is just the opening salvo from China, if you will, amid this tit-for-tat investigations into different probes, because the EU also launched probes into wind and solar companies from China as well. So if it does escalate into a full-blown trade war in the coming months and years, I think that's the bigger question that we want to watch out for.
Min Min, we've also got Chinese Premier Li Qiang wrapping up his visit to Australia today. He's over in Perth. What's on the agenda?
Yeah, he is visiting a Chinese-owned lithium plant in Perth, followed by a meeting with Australian and Chinese CEOs, I believe. And so far, the two sides have agreed on improving communications between their armed forces. And this is a very important point because there has been some near misses in recent times. I think just in May, Australia had accused a Chinese aircraft of sending flares near an Australian military helicopter in the Yellow Sea. And that was after an incident involving an injury of a Navy diver. So good progress there on this improved communications in the armed forces. The two sides also agreed in cooperation in other areas like climate change, education, cultural exchanges, as well as visa waivers for Australian citizens. But of course, there are all these intractable security issues at play as well, including Australia's growing ties with its American allies, its involvement in the AUKUS deal with the purchase of these nuclear-powered submarines as well. And taking center stage today, of course, is the issue of China's access into Australia's critical minerals sector. That's why he's visiting that lithium plant today. And we know Australia has been blocking some Chinese investments into the mining sector on national interest grounds. So certainly this is going to be a big part of Premier Lee's agenda. But we're not sure how much progress we can see on that front, because the Australian Prime Minister has also said that while Australia will engage with China where it can, it will also disagree where it must, and it must engage on its own security interests.
All right, China correspondent Min Min Lo there. Some of the other stories we're following today. Canada's government is buying a stockpile of rare earth materials mined in its Northwest Territories to prevent them from going to a Chinese buyer. Australian-owned miner Vital Metals will sell the stockpile to the Saskatchewan Research Council for a little over $2 million. The intervention is part of Canada's push to block Chinese firms from delving further into its critical minerals sector. Former Thai leader Thaksin Shinawatra is set to be formally indicted on a royal defamation charge later on Tuesday. The accusations stem from an interview in 2015. Thailand's strict lèse majesté law protects the royal family from criticism. The court is also weighing a petition to disqualify Prime Minister Srettha Thavisin. He faces allegations of ethical violations after appointing a cabinet minister who spent time in prison. Russian President Vladimir Putin is going to travel to North Korea today. It's going to be his first visit in more than 2 decades. The trip comes amid suspicions that Pyongyang is sending missiles and ammunition to help Moscow's war against Ukraine. Our East Asia Government editor John Herskovitz joins us now. So John, what can we expect from this trip?
Well, we're going to see Kim Jong-un roll out a red carpet for Putin. It's his first visit there since 2000. We may see Kim greet him at the airport. North Korea is very good at ordering its citizens around, so we could see people lining the streets, cheering feverishly as he passes by. There there's also been some satellite imagery indicating there could be a military parade. So Kim may show off his latest military hardware, missiles, various systems for Putin, which he may look at for use in his war on Ukraine.
So, John, we know that North Korea possesses some of the largest stores of weapons. What do we know at this point that they've actually sent?
Well, they've sent artillery shells that are interoperable with the Soviet-era systems on the front lines in Ukraine. And South Korea said this could be as many as 4.8 million. Now, just for some comparison, the EU is struggling to fulfill a commitment of 1 million shells this year. So we've had these artillery shells, we've had missiles, ballistic missiles that have been sent, and North Korea is looking at sending even more munitions there. It's been conducting tests of weapons, some artillery systems that can strike maybe 50, 70 kilometers across the border with great accuracy, and some more missile systems. So it has things it wants to sell to Putin, and this trip may be the opportunity to get them to Putin.
So this could be more than just a symbolic trip. What are the implications then for the likes of South Korea and the U.S.?
It really depends on what Russia is returning to North Korea. The more military technology that North Korea gets from Russia, the more threat that North Korea possesses for the region. It makes it more lethal for the U.S. forces in South Korea and Japan. It could increase their ability to deliver a nuclear strike on the United States. And also for the war in Ukraine, the more missiles that Russia uses from North Korea, the more it depletes North Korea's air defense systems, which means more supplies that have to be sent from the U.S., the EU, and its partners to keep Ukraine secure.
John Herskovitz, great to get your insights, our East Asia government editor, and we have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia Trade. Here are the latest from the corporate front. Apple is shutting down its Pay Later program, which let customers make purchases using an installment plan. The firm says third-party services, including ones from Citigroup, will instead be integrated into its upcoming software update. Apple launched its Pay Later program in the U.S. last year using an in-house platform. Adidas says it's investigating allegations of corruption in China after getting an anonymous letter alleging potential compliance violations by some employees. Screenshots of the letter that circulated in China show it claims workers received kickbacks from external service providers. Adidas has already faced consumer boycotts in China and a significant hit to sales. GameStop CEO Ryan Cohen says he's focused on turning the video game retailer around by boosting profitability and avoiding the hype of the meme stock frenzy. Cohen was speaking at an annual shareholder meeting that was delayed from last week by technical issues. GameStop has struggled to pivot away from physical stores to a digital-first strategy.
Revenues without profits and prospects of future cash flows are of no value to shareholders. This means a smaller network of stores with an expanded assortment of higher value items that fit into our trade-in model. We are not here to make promises or hype things up. We're here to work.
Stick around. We have more on the Asia trade. This is Bloomberg. This is the Asia Trade, about 30 minutes away from the major market opens. Here are the top stories that you should know. France's agriculture ministry says it's been informed that China's anti-dumping investigation into pork imports from the EU will last for 1 year. The narrowly targeted measure is the latest move in simmering trade tensions between Beijing and Brussels. A positive open ahead for Asian stocks after tech drives Wall Street to fresh record highs. Analysts are rushing to boost targets, with Evercore ISI predicting another double-digit rally for the S&P 500 through the end of 2024. And the RBA is expected to hold its key interest rate at a 12-year high today as it tries to rein in sticky inflation. The central bank forecasts the CPI will only return to target late next year, underpinned by an ultra-tight labor market.
Yeah, let's take a look at how Australian assets are tracking ahead of that decision. Not a great deal of change for the Aussie dollar. It's pretty steady, just above 66 cents US there. We have seen yields on the 10-year just easing off all week. We're parked at 412.99 at the moment. Futures, meanwhile, we're setting up for a positive open in about 30 minutes' time. Probably more of a function of the good day we saw for US markets. Well, joining us now here in the Sydney studio is Su-Lin, Head of Australia and New Zealand Economics and Fixed Income Strategy at RBC Capital Markets. So, Sue, thanks for joining us.
Morning.
So no change expected from the RBA today, 4.35%. That's 5 meetings in a row now. We've got elevated inflation. The labour market's still pretty tight, but we've had Governor Michelle Bullock really being quite equivocal about where to next. What are you expecting to hear from her in the press conference?
So no change to rates. I think that is universally expected, but we suspect that the overall tone of the statement today, as well as her press conference, will be rather cautious and continue to signal that they're not ruling anything in or out. So maintaining maximum optionality as they wait and watch and be patient for more data. And the key data really is around inflation and the labour market, as you say, Paul, because inflation is elevated. The April reading was probably a little bit too high. The May labour force continues to signal a tight labour market, unemployment rate around 4% and ongoing jobs generation. And so this challenge in terms of getting inflation back to target within a reasonable time frame is still very much the challenge for them. So, yes, I think it will be a cautious approach from them and still signalling concern about inflation.
Yeah, growth particularly an issue as well. It's looking rather sluggish at the moment, but if we were to ask the RBA what's more of a priority, getting inflation under control or promoting growth, which would it be?
Well, this is the kind of balancing act that they've signalled, and very consistent with the narrative of the narrow path, trying to get inflation back towards target and being more confident that it will get there within a reasonable time frame, yet also doing as little damage to the labour market as possible and not having growth slide any more than they want. And so it is a challenging balancing act. We sense from the RBA that they've elevated the full employment objective, that they're very keen to protect the labour market and the gains and not inflict too much damage, but that comes at a price. Maybe it is a slower return in terms of inflation to target, and that brings risks and challenges. And so it's a really difficult balancing act. For the RBA, we think the most prudent thing is to sit there and wait a bit longer. We do have a lot of fiscal stimulus coming through in the second half of the year, income tax cuts in particular. How much of it will be spent? I think there is some uncertainty. And so when you're so uncertain about that trajectory of the strength of the consumer, inflation, the stickiness of services, you're best to wait and see how the data evolves.
How long will that take then, Su-Lin? Because as you mentioned, we have the tax cuts, not to mention the rebates when it comes to those energy bills. So how long does it take for all of that fiscal spending to filter through the economy and sort of the RBA get an indication of whether that money will be spent?
Look, all of that stimulus from both the Commonwealth and some of the states begins to kick in from 1 July, but it will take some time. I think it will be several months before we get a sense of how much consumers actually spend in terms of that boost to disposable income, how much they may be prepared to save. A lot of those dynamics depends on the health of the labour market, and while it still remains pretty healthy, we know it is moderating and loosening. And so I don't think it'll be until Q4 that we get a sense really of how all this fiscal stimulus will feed through the economy, and particularly around the consumer, which will really be key for the trajectory of growth. So the prudent thing would be to sit and watch the data to see how the activity numbers evolve, the household expenditure numbers, and obviously inflation as well. So inflation is still too high. The core measures are above 4%, as are the key services and non-tradable. We need to see more progress on that, and again, that's going to take some time, particularly given that it's really the quarterly numbers that are key for the Reserve Bank. There's a bit too much noise in the monthly data, and so again, you're kind of waiting for a couple more quarterly inflation prints, and again, that takes you into the latter part of this year. So I don't expect anything to happen before then.
Is that sort of the strategy that they're adopting for global monetary policy as well? Because we have seen the ECB and the VOC move, but the Fed hasn't really done anything yet.
Yeah, it's interesting, the global easing cycle, which has kicked off from both the ECB and the Bank of Canada. And it is domestic considerations that I think are driving these responses. And the interesting thing with global central banking policy at the moment is that there's leaders and there's laggers. And clearly there's a few of them out early, beginning the easing cycle. The Canadians in particular, who have had a much weaker labour market and much more significant progress in terms of inflation, with annualised core measures down below their target. They're much more confident moving, whereas others really need to wait and see. They need more confirmation that inflation is making more progress towards target and have to be more confident on that front. And that's the likes of the Bank of England, the Fed, and definitely the Antipodeans, the RBA and the RBNZ. So there's I think, a differing pace in terms of the global easing cycle, a lot of that driven by domestic considerations. And I think more importantly, the question that will be asked increasingly as this global easing cycle kicks off is what the magnitude of it is, the pace of easing, how much and where terminal ends up. And that's a much bigger debate, all I think around this idea of a higher R star. And the RBA will be very cognizant of all of that in the background as it sits there and deliberates on the most appropriate stance of policy as well.
Just in terms of the inflation story here in Australia, when you start stripping away the numbers and you say you take out rent, take out financial services inflation, suddenly the picture doesn't look too bad. You know, we're getting back into that target window range. So is the brute tool of just keeping rates elevated really enough to address this problem?
Look, you know, we say it often, monetary policy is a blunt tool. Brute may be the word that can be used. And we know it doesn't impact directly on key components of CPI, particularly those that are supply constrained. The rental story is part of that, for example, or there's other structural factors going on. Higher insurance is also part of that. But for the Reserve Bank, I think the key here is there's only so long inflation can remain above target and high before it starts to really impact upon inflationary expectations, and then you run the risk it becomes embedded for too long, entrenched and high, and causes much more damage. So while you're right, Paul, that tool is limited, the key really is to keep expectations anchored. Now, that seems to be the case so far, but the longer inflation remains above target, the harder that will be. So that's a challenge for the bank here as it tries to balance that against doing as little as damage as it can to the broader economy and the labour market.
All right, Su-Lin, head of Australia and New Zealand economics and fixed income strategy at RBC Capital Markets. Thanks so much for joining us. Shery.
Right, Paul, let's take a look at how U.S. futures are trading at the moment because, of course, we have seen that higher for longer narrative play out. We're talking about the RBA. We have heard that same idea from the Philadelphia Fed President Patrick Harker talking about needing several more months of improving inflation. Still, the fact remains that traders are pricing in for rate cuts, delayed as they might be. So we have seen the S&P 500 hit a 30th record high this year already. The NASDAQ 100 also around that 20,000 mark, while Treasuries took a hit, given that we are seeing a little bit of a more risk-on sentiment spreading around the world. Marathon Asset Management Chairman and CEO Bruce Richards now saying that the strength of the U.S. economy means the Fed will proceed cautiously and slowly on rate cuts. In the meantime, he told us why investors should stay bullish on both stocks and credit.
Yes, the inflation number is getting softer and trending down towards that 2% goal that everyone wants to see, and that's really good news. But here's the thing that I'm thinking about. If you're Fed Chairman Powell, are you going to ease so quickly when equity markets are all-time highs, job markets are incredibly strong and robust, and the economy is strong? Because if you were to ease, might it just inflate a little bit more the economy, equity markets, and cause these animal spirits to come back and inflation to come back. And so they're going to go, I think, very, very slowly and very, very cautiously. So you might expect one ease or two eases and then a long pause to see, did it do anything to reinflate inflation?
Yeah, but is all this ends up being academic to a certain extent? Because we keep talking about what the Fed may or may not do. And the question I guess I really have is, does it matter, right, at least in the here and now, for the economy and the markets? I mean, 25 basis points, even 50 basis points of easing. Does that have a material impact?
The U.S. economy is so strong, and the reason why it doesn't have a material impact is because the Fed really doesn't matter. And that's really hard to say. No, they don't really matter, given the amount of fiscal stimulus that's happened. And the fiscal stimulus has been so exorbitant, so huge, never before seen in a growth market like we've had, and yet it came through in trillions and trillions and trillions. I'm talking about Infrastructure Act, the CHIPS Act, and many other acts that added trillions of stimulus at the time the Fed was tightening. So I would say that you're right about that. It is a bit academic because here we are at higher rates and the economy is just fine. You have to stay bullish because the economy is strong, jobs are strong. Stock market, we're going to see what's going to happen with second half earnings, and we're going to have record earnings in the third and fourth quarter. So I'd say stay bullish for equities and stay bullish for credit as well, because a higher rate environment that we're seeing is really, really bullish for the bond market.
Marathon Asset Management Chairman and CEO Bruce Richards there, speaking with our colleagues Romaine Bostick and Alex Steele. More ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade. South Korea's largest organization of doctors is expected to hold another strike today over government plans to reform the medical system. For more, let's bring in our Korea economy and government reporter Soo-hyang in Seoul. Soo-hyang, so this has been going on for months now. What's the deadlock?
This walkout has been going on for nearly 4 months now, and we're really not seeing a breakthrough, as you can see with this massive rally scheduled in Seoul later today. So at least 20,000 doctors from across the country are expected to join the rally and demand the government to cancel its plan to increase the medical school quota. I guess one of the reasons this could go on for so long is because, in part, doctors are actually, despite their threats, holding the fort, providing medical care for critically ill patients and keeping the emergency rooms open. The government, too, despite their threats, it's really hard for them to take stern action on the doctors, such as canceling their medical licenses, because, after all, the inconveniences would fall on the general public, who really needs to see these doctors and get their treatment and surgeries done.
Okay, so how is the government reacting to the collective action then?
The government has warned of stern punishment for those who violate the country's medical law, which stipulates that anyone who refused to accept patients without due reason can be punished. But the government has also opened military hospitals for general public, and it has been providing funding for medical professionals who have been filling in this gap during the walkout.
So, Soo-hyang, you've said that doctors have been performing their jobs, at least when it comes to patients in critical care. So, where does the general public stand in this deadlock?
Public is generally in support of the government, but they are growing tired of this prolonged deadlock. So as of Monday, we're hearing that 4% of the clinics across the country will stay closed. The number could increase, which means tens of thousands of canceled appointments. So that could have an impact on the public sentiment. But the major hospitals said they will continue to open their emergency care units and the emergency rooms.
Our Korea economy and government reporter Soo-hyang, they're joining us from Seoul as we continue to watch that ongoing strike by doctors across South Korea. We'll have more ahead on the Asia trade. This is Bloomberg. This is the Asia Trade. We're 12 minutes away from the open of assets across Japan. We have seen the Nikkei seeing its worst day since April as we get Japan's AGM season started. The Japanese yen has really held steady after weakening immediately after the BOJ policy decision last week. Of course, we have seen the Japanese yen sort of tending to weaken after BOJ decisions, but we're watching JGBs very closely. They extended gains. We have seen some risk-off spread because of political uncertainties across in Europe, but also uncertainty over reductions of BOJ's JGB purchases. Today, we are seeing a little bit more risk-on sentiment, so we'll see how we come online. But one stock that we'll be watching, Toyota, its executive board may face some tough questions at the car maker's annual meeting today after safety investigations halted the shipment of some models. For more, let's bring in Katrina Nicholas, who leads our Asia transport coverage. Katrina, so what are some of the key challenges facing Toyota right now?
Yeah, well, look, Toyota really coming off something of a banner year. I mean, raked in $5.4 trillion, which is $34 billion in the year through March. This is the first time a Japanese company has surpassed the 5 trillion yen threshold. Production and sales also hit record highs, which helped to cement Toyota's status as the world's top car maker for a fourth consecutive year. But it certainly hasn't been without its challenges. The company has been hit with more fallout that sprung from a safety certification investigation in recent weeks. And the company has also suspended shipments of a handful of models, and it's had some government officials raid its offices. Another sort of question that I'm sure investors will be looking at closely when the company holds its AGM a little bit later in Japan today is its electric vehicle strategy. That's also come under a little bit of scrutiny. And, you know, that's, even though Toyota makes a lot of hybrids, which has been a welcome trend for Japanese car makers, the shift has cast doubt over Toyota's goal whether it can sell about 1.5 million battery EVs annually by 2026.
So a number of issues here, Katrina. Are any of them enough to cause some problems for Chairman Akio Toyoda as he seeks re-election?
Yeah, look, that's a really good question. Late last month, there were some institutional investors that actually voted against Toyota's reappointment, pointing to those certification problems and a lack of independence on the executive board. The California Public Employees Retirement System, which is the biggest pension fund in the U.S., and the California State Teachers Retirement System also have voted against his re-election. I would say, though, you'll probably see Toyota re-elected to the board, but investors will be keeping a close eye on what the percentage re-election is. Last year, it was around about the 85% mark, which was the lowest since about 2013. So he's likely to be re-elected, but the margin to which he gets back in will be closely watched.
Katrina Nicholas there, who leads our Asia transport coverage with the latest from Toyota. And of course, we have seen more shareholder activism across Japan, and Japanese firms have now received a record number of proposals from institutional investors in this year's AGM season. Our senior Asia stock reporter Hideyuki Sano joins us now. And Hide, I mean, it's a busy couple of weeks ahead, and we were sort of expecting this sort of increased level of activism.
Exactly. So a record number of 45 Japanese companies has received a proposal from activist investors this year. And, you know, activist proposals are normally voted down because normally most other investors side with companies' management rather than activists. But then again, many Japanese institutional investors and also foreign investors have been sort of more open about siding with activists these days. So what we're likely to see this year is increase in support for activist proposals. And basically that is driven partly by the Tokyo Stock Exchange's campaign to or put pressure on companies to consider more about boosting their share prices.
So can you give us some examples of companies that have received shareholder proposals?
Right. So Katrina has just talked about Toyota. I mean, Toyota received a proposal related to ESG topic. But perhaps one of the most symbolic one this year is Keisei Electric Railway, which is, of course, a railway company. But it has huge unrealized gains on its holding of Oriental Land shares. Oriental Land is the operator of Tokyo Disneyland, and its share has basically increased like 10 times over the past few decades. So Keisei has a lot of money, at least on paper. So investors want Keisei to use some of that money to either buy back its own shares or to spend more to grow its business. But Keisei Electric has been basically very, very cautious and almost using this Oriental Land share as a rainy day fund. And activist investor Palliser came up with a proposal earlier and to reduce shareholding in Oriental Land, and Keisei reacted only a little to that proposal. So Palliser came up with an official sort of proposal at the AGM. So it's going to be very interesting to see how shareholders will react.
Just quickly, we started this conversation talking about how jam-packed the next couple of weeks are with AGMs. Yeah. Will that sort of help some of these companies dodge some of those questions from activists?
It's hard to say. I mean, these days, you don't need to be physically there to exercise your vote. So it doesn't really mean that activist rights are in some ways sort of curtailed by this concentration. But then again, probably if you have more time, it's better. So it's hard to say.
Well, 2,100 companies, AGMs, 98% of listed firms whose financial year ends in March. So we'll continue to watch the developments in the next couple of weeks. Hide-san will be actually busy this couple of weeks following all of those developments. Our senior Asia stock reporter. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we saw a little bit more risk-on sentiment overnight, despite the fact that the Philadelphia Fed president only talked about one rate cut being appropriate this year. Paul, we might get that higher for longer narrative from the RBA as well.
That's absolutely right. We do have an RBA meeting in just a few hours' time. No change expected, but yes, it is the language we're watching closely. The RBA, well, depending on how you read it, maybe had a hawkish tone of the past few meetings, Shery.
Yeah, take a look at how we're setting up for the Asia market opens, because overnight we have the exuberance because, yes, it might get delayed, but we are going to see a rate cut from the Federal Reserve very soon. And that's really sent U.S. stocks to another record high. The S&P 500 seeing its 30th already this year. We're seeing some downside pressure for the Nikkei and the topics at the open. Oh, there we go. At the open now, up 0.9%, because we had seen already the worst day for the Nikkei since April. So that positivity that we saw overnight actually filtering through the Asian session, although we're not really seeing much of a change when it comes to the Japanese yen. We haven't really seen much change in the Japanese yen level since that initial weakening from the BOJ policy decision. But given where we headed there, we're watching JGBs very closely because we continue to see that rally and the 10-year yield below that 1% still. Take a look at how the Kospi is coming online. Of course, we're watching very closely that strike by the largest doctors association in South Korea. Just keep an eye on medical devices and that industry. The Kospi up 0.9% as the Korean won is seeing a little bit of strength around the 1378 level, Paul.
All right, let's take a look at how our Australian assets are doing. It is, of course, a staggered open here in Australia, so hard to get a read on things in the early going. So we're kind of flat right now. Just a few names trading at the moment. The Aussie dollar, meanwhile, that's holding pretty steady, just ticking up a little, 66.20 ahead of that RBA meeting. As mentioned, we are expecting the Reserve Bank of Australia to stay on hold, 4.3%. That'll be 5 straight meetings in a row. But the press conference will be one to watch. Michelle Bullock's been hedging her bets really on where rates might head next in Australia because inflation does remain sticky. The jobs market does remain tight. Take a look at how yields are going, backing off a little bit. We did see them rally in the US session as we await the next piece of data out of the United States, and that will be retail sales. All right, let's get over to our next guest now. Kelvin Tay is Regional CIO at UBS Global Wealth Management. And Kelvin, I want to talk about those yields that we've seen in the US. Do you think this is a good time to lock in an attractive yield with bonds?
Certainly. We do think that despite the fact that the yields have actually come down to about 4.2 to 4.3%, that this is still pretty much a good time to pick up these treasuries, largely because of the fact that, you know, the US Treasury yields are actually higher than your earnings yields on the S&P 500 at the moment. So that's one of the reasons why we prefer bonds to stocks at the moment, because we do think that where the yields are concerned, we do see the possibility of the 10-year yields dropping to about 3.8% once the Federal Reserve embarks on its rate cut cycle.
So the rate cut cycle is a point of contention, though. We've seen expectations gradually wound back over the past few months as far as that's concerned. And Patrick Harker there, as Shery just mentioned, says, well, maybe one cut's appropriate this year, but he wants to see several more months of improved data on inflation. Do you expect some further recalibration on the market in terms of the timing and scale of potential Fed easing?
Yeah, absolutely. We do think that the first rate cut should actually be in September, but I think the timing of that increasingly becomes quite uncertain. In any case, we do think that, again, with the US elections in November coming into the picture as well, if they don't cut in September, then the only likelihood of a cut will then be in December itself. But we do need the inflation numbers in the US to actually come off again. Right now, we do think that core inflation is actually coming down nicely, but the pace needs to actually quicken up and pick up a little bit more before the Fed actually decides to cut in September. So I think the timing is actually quite uncertain, but we do think that perhaps by the end of this year, one or perhaps even more, even 2 rate cuts is actually quite possible.
How concerned should we be, though, when it comes to the market rally and the breadth? Because it's been so concentrated around the Magnificent Seven and that exuberance over artificial intelligence.
Yeah, that's the biggest problem that we have at the moment because of the fact that, you know, where your Tech Plus is concerned, it's now basically close to about 50% of the S&P 500. Now, if you look at the how the S&P has actually moved since the start of the year, it's been largely concentrated on the Magnificent Seven stocks, as I actually mentioned, and that's already at about 32% of the index itself, whereas the rest of the market has actually been quite flat since the start of the year in terms of the performance. So if we were to actually split the S&P into S&P 500 and S&P 493, I would argue that the S&P 493 is actually not overvalued. In fact, it is actually fairly valued, given the fact that, you know, it hasn't really rallied dramatically since the start of the year.
And should we be also sort of positioning towards other names that have relation to artificial intelligence, but not necessarily directly? Because I spoke recently to the Microsoft Japan president, and she was telling me about how they're really positioning for clean energy sources for their new AI infrastructure built here in Japan. Take a listen.
So we have made a commitment in our data centers around the world to be net zero in the next few years. So everything we do is based on clean energy, and frankly, AI strategy is energy strategy. And a country like ours, to keep growing, we need that.
Kelvin, should we be buying renewables at this point?
Yeah, we've always believed that renewables should be a part of your strategy because I think that's a longer-term strategy and not a short-term strategy. We do think that that is a trend and not a fad, and therefore that's likely to be sustainable on a longer-term basis. You know, the interview just basically sort of like reinforces the trend for AI in the sense that, you know, artificial intelligence is a technology that you can actually use in every single sector, in every single business and industry, and not just in the tech sector. So the breadth and depth of the potential use for AI is huge. And that's one of the reasons why it's been so attractive and has been sucking in a lot of capital from global investors, largely because of the fact that it has the potential to change and to transform completely industries in the next few years ahead.
Yeah, data center construction is also rather carbon intensive. Do you see that changing in the future, and how would you invest around that story?
Well, we do think that with regards to the energy sector itself, we do see a lot more potential in solar and the other alternative sources, largely because of the fact that if you want to meet your Paris Climate Accord targets, you have no choice but to actually cut your emissions. And the only way to do that is basically to actually, embark on more renewables. And in that sense, we do think that solar probably has the best potential amongst all the other industries.
Kelvin, going back to the big macroeconomic topics, especially as we head towards the RBA rate decision as well, we're seeing a little bit of divergence across the world with the ECB, BOC cutting, and we're really not expecting much of a change when it comes to the RBA. How will all of that play into the dollar, given that we have seen incredible strength in the last few months?
Yeah, I mean, we do expect the dollar to remain pretty resilient on a short-term basis, largely because of the fact that, all the other central banks or the major central banks, like, for example, the ECB, will probably be cutting rates first, and that includes the BOE as well. And if the Federal Reserve does not cut in September and it delays the cuts further, then obviously the yield gap between the treasuries and the gilts and the bonds and etc. will actually widen even further. And that's basically what we think is keeping the dollar strong, because of the fact that, even the pension funds and the retirement funds in Japan are actually buying a lot of US Treasuries, and they hold to the tune of about 1.25 US trillion right now of US Treasuries. And that is not a number that we think is going to come off anytime soon, given the fact that at about 4.2%, the 10-year US Treasury yields are still very, very attractive on a yield gap basis.
Does that mean that there is really no way then down when it comes to the Japanese yen at this point?
Yeah, I think where the Japanese yen is concerned, we do really need the Fed to actually cut, because I don't think the BOJ is going to do anything soon, because of the fact that, inflation, if you look at core inflation or core ex-energy inflation in Japan, in the last couple of months, it has actually been in a disinflationary trend. So I don't think the BOJ is in any rush to actually to actually hike rates at this point in time. And, where the 10-year Japanese government bond yields are concerned, it has actually been hovering at just slightly below 1%. So if the yield gap doesn't narrow, then there's no way for the Japanese yen to actually appreciate. And again, the onus is on the Federal Reserve to actually cut rates first and actually allow the yield gap to actually narrow. And that's the possibility that is getting increasingly distinct. So if that doesn't happen, then obviously the yen is actually going to remain strong. And on a short-term basis, we do think that the Japanese yen could perhaps actually touch the 160 against the US dollar level again.
Given the monetary policy uncertainty, given the looming elections also, and just political uncertainty, even in Europe right now playing out, we are seeing more calls for cash as well. But how do you structure your exposure to cash at this point?
Yeah, if you take cash, if you put your money in cash right now, you're going to get reinvestment risk in the next 12 months, because once your cash rate starts to come off as a result of the cuts by the different various central banks, then you're going to see that you're going to miss out on an opportunity to invest in the bonds market right now, because of the fact that the yields are not going to remain at these levels for a long time, right? If you have another month of weak inflation data coming in or weakening inflation data coming in from the US, then obviously your cash rates are actually going to come off as well, because the market will increasingly start to price in the fact that the Federal Reserve will have to start cutting rates pretty soon. So I wouldn't advise putting into cash right now. Perhaps you might want to have actually 10 to 12% in cash, but anything more than that is going to be quite a big call to make.
Kelvin Tay, good to have you with us, Regional CIO at UBS Global Wealth Management, of course, with his calls on the broader markets. As we continue to watch some of those movers in the South Korean session, we're seeing Samsung and SK Hynix jumping at the moment higher by more than 1% for both stocks, but just coming at a time when we continue to talk about that tech rally, the Magnificent Seven, and really the exuberance and excitement over artificial intelligence. We have already seen the price of South Korea's semiconductor exports rising at a record pace in May. So that just shows you that the strength of the AI rally is powering not only these stocks, but also South Korea's economic momentum. We'll continue to watch all of these movers in the Asian session. More ahead on the Asia trade. This is Bloomberg.
All right, let's take a look at how assets here in Australia are faring. We've been going 13 minutes now, so we've got a better idea of how we're heading, and up seems to be the general momentum, where the ASX better by 0.5%. The rally pretty broad-based as well. It's just the materials sector that is lagging at the moment. Not a great deal of change to either the 10-year yield or the Aussie dollar as we await the Reserve Bank of Australia cash rate decision. That's coming up in just a few hours' time. And when that happens, we are expecting the central bank to hold the key interest rate at a 12-year high as it tries to restrain sticky inflation. Economics reporter Swati Pandey joins us now. So, Swati, the decision itself hasn't been particularly interesting for the last 5 meetings, but the commentary has. What are we expecting to hear today?
Yes, the commentary has certainly been interesting. Michelle Bullock, the governor, has sounded tough on inflation, even though they have left interest rates unchanged. We have seen inflationary pressures in the past. 2 data sets have actually surprised on the upside. So they have definitely sounded worried and a little bit uncomfortable. And then in March, we saw they did not discuss a rate hike, and that was the first time during this tightening cycle that they did not. And then in May, they brought back the discussion of a rate hike. So it will be interesting to see whether they do discuss a rate hike or not in today's meeting.
And they must not be too comfortable with the fact that we are going to get those tax cuts, not to mention the spending around the rebates on utility bills. I mean, that fiscal spending is supposed to filter through as well.
That is exactly right. It's going to be from July 1. I'm sure it will be a boost for a lot of people who are struggling. But then the tax cuts and the rebates are both going to every single household. So there are people who are probably not struggling to the extent that they need the stimulus. So they would definitely be spending that money. And that is happening at a time when Michelle says that the RBA has said several times that the aggregate demand in the economy is still above the economy's capacity to supply. Inflation is still hot. So at that time, if you are getting stimulus and people are getting some extra money to spend, it's not an ideal situation for sure.
Growth is not in a great place. We're not in a recession yet, but what's the chances that we stay that way? What are we expecting to hear?
Yes, growth is really anemic. It's been slow since the second half of 2023, and it looks like the second half of 2024 onwards should be better. So July 1, once we get the tax cuts, it looks like people will start spending, and the impact will feed through into the economy. So the expectations and general predictions are that the second half of this year should be good. And if interest rate cuts do happen in the second half of this year, on November is where some economists are predicting, that's an added boost as well.
All right, economics reporter Swati Pandey there, and that RBA rate decision about 4 hours, 15 minutes away. Coming up later today, we're also going to speak exclusively to the Bank of Thailand governor about his outlook for the nation's economy and political pressure for an interest rate cut. That conversation coming up at 11 a.m. Hong Kong time, 1 p.m. if you're watching in Sydney. Well, Chinese Premier Soo-Hyang is visiting a Chinese-owned lithium plant in Western Australia as he wraps up his 4-day visit. China correspondent Min Min Lo joins us now. So, Min Min, what else is on the Premier's agenda today?
Yeah, he's visiting the Chinese-owned lithium plant, followed by a meeting with Chinese and Australian CEOs. And this is really part of China's push to ask for more market access into Australia's critical mineral sector at a time when Australia has been pushing back. We know Australia has asked 5 Chinese-linked companies to divest their shares in an Australian mining company. This comes as Australia joins forces with the US in this critical minerals partnership to tackle what they see as Chinese control over 2/3 of the global supply chain when it comes to critical minerals. So it remains to be seen whether Premier Lee will be able to achieve his objective on this trip, given that Australia is looking at this sector as, quote, an opportunity of the century, given its importance to the renewable energy sector. And the Australian Prime Minister has also said that while Australia will cooperate with China where they can, they must disagree where they need to, and they will engage on their own national interests.
So, Min, what's been achieved so far then?
Yeah, China and Australia, they have agreed to improve communications between their armed forces. This is quite an important point to avoid further skirmishes in the Asia-Pacific because there's been some near misses in recent months. In May, Australia had accused China, a Chinese aircraft, of sending flares near an Australian military helicopter in the Yellow Sea, and that was after an incident involving the injury of a Navy diver as well. Now, the two sides have also agreed on further cooperation in areas like climate change, education, cultural exchanges, as well as waivers for visas for Australian citizens. But there are still these sticking points. Australia obviously will want China to roll back those curbs on some products like lobsters, as well as two beef processing plants as well. And China also wants Australia to stop opposing it from joining this trade bloc known as the CPTPP. So plenty of issues that are still remain as sticking points between these two countries, but it looks like both sides are committed to at least keep relations on track.
China, meanwhile, has launched an anti-dumping investigation into pork imports from the European Union. What are the risks of this escalating?
This is so far seen as quite a targeted retaliation because it affects about $1.8 billion worth of goods that's traded between EU and China, mainly affecting countries like Spain and the Netherlands. But still, overall, China-EU trade stands at over $280 billion. So this is just affecting just under 1% of overall EU-China trade. So China clearly is still being very cautious here in terms of their retaliation. The last thing they want is to drive the EU closer to the US when it comes to their anti-China stance, and the risk of that escalating is, going higher as we see that EU elections, the rise of these right-leaning parties going into parliament. So this is something that China really wants to avoid at all costs. But of course, it's not the end of the game yet because Europe has launched investigations into Chinese solar and wind farms as well. And they're also looking into Chinese restrictions into the medical devices industry. So plenty more to come. It's something that we will watch closely, this tit-for-tat levies that could potentially be unleashed in the coming months.
Yeah, and we haven't even talked about the U.S. elections coming up and that election risk as well. China correspondent Min Lo there with the latest on China and some of the geopolitical stories that we're following. And here are some of the other top stories in this field, because Canada's government is now buying a stockpile of rare earth materials mined in its Northwest Territories to prevent them going to a Chinese buyer. Australian-owned miner Vital Metals will sell the stockpile to the Saskatchewan Research Council for a little over $2 million. The intervention is part of Canada's push to block Chinese firms from delving further into its critical mineral sector. Former Thai leader Thaksin Shinawatra is set to be formally indicted on a royal defamation charge later on Tuesday. The accusations stem from a 2015 interview. Thailand's strict lèse-majesté law protects the royal family from criticism. A court is also weighing a petition to disqualify Prime Minister Srettha Thavisin. He faces allegations of ethical violations after appointing a cabinet minister who spent time in prison. We have more ahead on the Asia trade. This is Bloomberg.
I think that the French Republic and the French citizens will understand the enormity of the decision on 30th of June and then on the 7th of July. And I'm confident that there will be a for Europe and for France positive outcome.
Now, as the Dutch Prime Minister speaking in Brussels, take a look at how European futures are coming online. We saw French stocks rebound in the overnight session after losing more than $200 billion in value last week. But that wasn't really enough to help the European benchmark. You can see futures pointing to the upside, but we actually had the Europe 600 index finishing little changed because Citigroup downgraded the region's equity, citing heightened political risks. And of course, we're not even talking about monetary risk. We do do have the BOE, the Swiss National Bank, and Norway's Norges Bank deciding on policy this week, Paul.
All right, let's get some morning calls now. Citigroup strategists have lowered their view on European shares to neutral from overweight. They say prospects for a far-right majority in the French Parliament have introduced considerable uncertainty for European policy. On the other hand, they've upgraded US stocks from overweight or to overweight from neutral as they focus on technology and industrial shares. Veteran hedge fund manager Philip King, meanwhile, has taken a short position in shares of the Commonwealth Bank of Australia. The chief investment officer at Regal Funds Management notes that the lender is the priciest on the MSCI World Bank Index, with a forward price earnings multiple of 22 times. He also expects the bank's earning per share to decline in the coming years. Okay, let's take a look at how we're tracking in terms of US futures. We've got S&P E-minis in positive territory. We did, of course, come very close to setting yet another record on the S&P in the US session. That would have been the 30th one this year. We are also counting down to retail sales out of the US. They're expected to show ongoing consumer resilience. We'll get those numbers in a few hours' time. US Treasuries, meanwhile, we had yields rallying into that retail sales number, but got them just pulling back a little bit. Yield on the 10-year there, 4.2692. Shery.
Yeah, I mean, we have seen treasuries now fall after advances in the previous session, right? And this really to do with that flurry of high-grade corporate bond sales that topped $21 billion. That was led by Home Depot. Not to mention that we also had that higher for longer narrative continue. The Philadelphia Fed President Patrick Harker saying that he's seeing only one rate cut as appropriate for this year after several, quote, several more months of improving inflation that he wants to see. And of course, the markets have been pricing all of that in, especially really rebounding a little bit from that safe haven drive that we've seen after the chaos in Europe and really that hitting the bond markets across Europe as well. So we're seeing a little bit more risk on sentiment across the world at this point. More ahead on the Asia trade. This is Bloomberg.
All right, we're just getting some breaking news out of Singapore. It is non-oil domestic exports for the month of May. Now, they're coming a little bit better than expected, just a 0.1% contraction for the month. The expectation was for a 1.1% contraction. I beg your pardon, that's on year. The electronics exports on year, meanwhile, showing a pretty healthy bounce, 21.9. But again, the non-oil domestic exports on month just contracting 0.1% on month. That is. There's a slight contraction, a little worse than expected, but better than expected for the May figure on a yearly basis. All right, Shery.
Yeah, Paul, take a look at how markets are trading at the moment. We are seeing big gains for the Nikkei coming off the worst day since April and being led higher by materials and information tech stocks. We're seeing also the Kospi gaining 0.9%. Of course, we've been watching that strike by the largest medical association there. The ASX 200 also up 0.6%, really setting up for the RBA to stay on hold today's decision. And we're watching some of those movers. As I mentioned, tech is really up today, but one stock that we're watching is e-manga company Infocom. It's now rallying as it's saying that its board came to a decision when it comes to a Blackstone offer. We had heard from Blackstone that it reached a final agreement to acquire Infocom through a takeover offer priced at 6,000 yen per share. That's according to a Nikkei report. And now we're getting some confirmation that Infocom is saying that it held a board meeting on Tuesday and has come to a decision on that buyout offer. Right, let's talk a little bit about China because the biggest tech firms are pulling out all the stops during the annual 618 shopping festival, which officially wraps up on Tuesday. It's also a make or break moment for an industry that's still struggling to escape its COVID-era trough. We saw China's retail spending picking up last month, but it still remains weak by past standards. Joining us now is Shery, Managing Director and Partner at Kearney China. Shery, great to have you with us. Does this give you a little bit more optimism that spending might be picking up in China?
Yeah, I see the May statistic going up, and this gave us some optimism, which is driven by the 618 shopping festival, and because the early start of the shopping festival. So compared to last year, there will be, for example, for Tmall, one more week, right, in May. So that's one of the driver, and another driver for that 3.7, which is 1.4%. higher than April, is also the government's initiative on really stimulate the durable goods, especially home appliance, by using the new replace used incentive to stimulate, I would say, in the short term. This is also to make up the kind of slow growth or the kind of like not so good performance of the durable goods sector in China. But overall,
so, Shery,
I would say yes, please.
Continue.
But overall, I would say the June 18th, the sales increase would likely remain flat compared to last year. And this is what we observed the similar pattern, right, for 2023 over the year before. This is due to the the price, I would say the discount, the value. This has become a keyword in China over the last 1 to 2 years. So people say everyday discount, right, for Pinduoduo, and people also say not very fast increase of the discount format, so that people would say less of the price advantage in 618 compared to the normal days.
So tell us a little bit about how that compares, especially when it comes to consumption and consumption patterns that you're seeing this year as compared to last year, for example.
Consumption pattern, I do say, right, I would say one key word is really people become more rational, more mature. We see that people pay attention to both price and value, right? This is for the, I would say, for mass segment, the price is not only thing, and people also pay attention to quantity. So only the cheap price would not really motivate that much of sales. While for maybe a little higher segment, people also not only willing to spend premium on the brand, right? People want to spend premium on quality. So the people really become more rational. This is a key word, I think, in this industry over the last 1 to 2 years. Another key trend, we would really say the consumption behavior varied more by different consumer segment as well as by different product category. And so in terms of consumer segment, for example, for the people maybe age about 40 to 65 in tier 1 to 3 cities, those are the people that you say typically benefit from the fast growing economy in China over the last decades, right? So they're the one will be more optimistic. However, similar age group in rural area would be the one would be more pessimistic. You would say also the sentiment among the a little younger generation, Generation X, in the top tier city, they will be more concerned, more worried, because they have the pressure on kids' education, on the mortgage, etc. So the consumption behavior would vary because of different sentiment among different segment. Consumption would also vary by different product category. For example, the category that are more education, food and beverage, which is basic, and then the health-related health supplement, and also travel are the segment that gain growth, right? Because of different generation of consumer, different stage of China. While for the durable goods, like the home appliance, 3Cs are the ones really suffered. So you really see that difference as well.
Well, we've seen some government support so far for consumers, particularly around those replacements of major appliances, a few other policies as well.
Yes.
Has it been enough to prop up consumer sentiment in your view, or do you think some more needs to be done here?
I think the government's initiative is exactly the reflection of the slow down of the industry in the durable goods. So government want to address that, and that is also driven by the real estate, right? So we do say the government's policy on how to say, like the regain and the confidence or regain the value of the real estate industry could enhance the durable product sales, right? That really need to home appliance, etc. So in addition to the initiative you mentioned, I think that one is more fundamental as well.
So what's the strategy for retailers here? Do they offer steeper discounts? Do they look for cost savings? What's the approach?
Yeah, so we do have work a lot with different type of retailers. So I would say one really major trend, and if you say the number one trend in the retail industry is really the value, as we mentioned. So different format, you say, really have different type of, I would say, growth, right? So the format that really gain the highest growth would be number one, the membership. Sam's Club are the ones really grow very strong, right? Like their per store sales is like 70% higher in the US. And while also another format is discount format. It's the one also gain a lot of growth. So you say, for example, leading player like Ningshi Henman, like Haoxiangnai, they grow like a few stores every day in that type of speed. And so the value format would be the one really gain strong growth. And another major trend in the retail industry is really the private label. And so across all different formats, private label is the number one strategy for the retailers, right? To really gain their price advantage, to gain their differentiation to the consumer, also to gain their margin back. And that actually in turn also impacts the...
Shery, we're going to have to leave it there, I'm afraid, but thank you so much for joining us. Yeah, all right, that's Managing Director and Partner at Kearney China, Shery He there. We have more ahead on the Asia trade. This is Bloomberg. Nickel is a critical component of the batteries that power electric cars, and Indonesia's become a global giant in its production and processing. But there is a dirty and sometimes deadly secret behind that success story. Bloomberg's been investigating for today's Big Take.
This island was once covered in forest. Now it's being transformed into a global hub for nickel, a metal crucial for making electric vehicle batteries. The Indonesian island of Sulawesi feeds the world's largest battery makers, who power virtually every major seller of EVs. And that's coming at a major cost.
13 people have died and dozens more are injured after an explosion at a nickel plant in Indonesia.
People in Sulawesi say they're risking their lives and health to make a living.
There is air pollution. Cheap power in Indonesia comes from coal. These are very dirty facilities.
Kemarin ada salah satu teman saya yang terkena percikan potongan besi itu sampai menimbulkan cacat permanen.
This has been a big economic success story despite the environmental and human cost. And certainly decision makers in Jakarta don't intend to wind back their promotion of this industry anytime soon.
Let's now bring in our battery metals and mining reporter, Annie Lee. Annie, tell us a little bit more about your team's investigation into these mines and the really health and safety hazards there.
Good morning. Sure. So over the past year, my colleague Matt Campbell and I, we have interviewed dozens of EV industry insiders, key stakeholders along the supply chain, and Chinese and Indonesian workers that work in these industrial parks that produce nickel, which are essential to the global EV transition. We traveled to the island of Sulawesi, where some of these nickel hubs are, and there have been evidence of long history of workers' injuries, fatal accidents that we've seen like happening over and over again. And yet, these nickel sourced from these plants, we found that they are present, or they will be present, in the supply chain that fits into virtually every major seller of electric vehicles in the future. So this story, we look into this cost, this human cost, and the price that is happening in Indonesia coming out of the global EV transition.
Annie, of course, Indonesia is not the world's only supplier of nickel, but it is certainly a significant one. How significant is it to the country, and what's being done to try and clean things up?
Yeah, so I think it is important to acknowledge that the significance of Indonesia's nickel supply to the world. So the country has a policy to encourage downstreaming, and this is what draws in a flood of Chinese investments to there to build the plants, and they bring in these technology breakthroughs, and also alongside the cheap labor and the cheap power from Indonesia, it has made other countries find it very difficult to compete with Indonesia. So right now, half of the world's nickel are coming from Indonesia, and we've spoken to industry analysts that about 2/3 of them will the world supply will come from Indonesia. So this is huge. And even Tesla's recent impact report also mentioned that the global transition will not be able to happen without the Indonesian nickel. So this is a very important part that we have to look at. As in, the question now will be who and how in the supply chain should be addressing this cost and the price coming from the global energy transition.
All right, our battery metals and mining reporter Annie Lee there. And subscribers can read more about that story on the terminal. NI Big Take is your function there. Or you can listen to our Big Take Asia podcast on iHeartRadio, Apple Podcasts and Spotify. All right, let's take a look at how some of these commodities are tracking at the moment. The Bloomberg Commodities Index has been ticking down a little, but we've got some of those metals we've been discussing, nickel in particular, just gaining a little by 0.1% at the moment. Iron ore prices, meanwhile, are recovering reasonably well. 1.81% gain at the moment for futures traded out of Singapore. And on that note, even the materials sector here in Australia has just turned modestly positive. We've now got the entire index higher. The commodities index, though, as I mentioned, that's off by 0.5%. Marathon Asset Management Chairman and CEO Bruce Richards says the strength of the U.S. economy means the Fed will proceed cautiously and slowly on rate cuts. In the meantime, he told us why investors should stay bullish on both stocks and credit.
Yes, the inflation number is getting softer and trending down towards that 2% goal that everyone wants to see, and that's really good news. But here's the thing that I'm thinking about. If you're Fed Chairman Powell, are you going to ease so quickly when equity markets are all-time highs, job markets are incredibly strong and robust, and the economy is strong? Because if you were to ease, might it just inflate a little bit more the economy, equity markets, and cause these animal spirits to come back and inflation to come back? And so they're going to go, I think, very, very slowly and very, very cautiously. So you might expect one ease or two eases and then a long pause to see, did it do anything to reinflate inflation?
Yeah, but all this ends up being academic to a certain extent, because we keep talking about what the Fed may or may not do. And the question I guess I really have is, does it matter, right, at least in the here and now, for the economy and the markets? I mean, 25 basis points, even 50 basis points of easing. Does that have a material impact?
The U.S. economy is so strong, and the reason why it doesn't have a material impact is because the Fed really doesn't matter. And that's really hard to say. No, they don't really matter, given the amount of fiscal stimulus that's happened. And the fiscal stimulus has been so exorbitant, so huge, never before seen in a growth market like we've had, and yet it came through in trillions and trillions and trillions. I'm talking about Infrastructure Act, the CHIPS Act, and many other acts that added trillions of stimulus at the time the Fed was tightening. So I would say that you're right about that. It is a bit academic because here we are at higher rates and the economy is just fine. You have to stay bullish because the economy is strong, jobs are strong. Stock market, we're going to see what's going to happen with second half earnings, and we're going to have record earnings in the third and fourth quarter. So I'd say stay bullish for equities and stay bullish for credit as well, because a higher rate environment that we're seeing is really, really bullish for the bond market.
Marathon Asset Management Chairman and CEO Bruce Richards speaking with our colleagues Romain Bostic and Alex Seal. And that optimism that you heard over there, we're actually seeing it play out in the markets across Asia right now. Following Wall Street higher, remember, a 30th record high for the S&P 500. We're seeing major benchmarks across Asia rallying at the moment. This is Bloomberg. You're watching the Asia Trade. The latest from the corporate front, Apple is shutting down its Pay Later program, which let customers make purchases using an installment plan. The firm says third-party services, including ones from Citigroup, will instead be integrated into its upcoming software update. Apple launched its Pay Later program in the U.S. last year using an in-house platform. Adidas says it's investigating allegations of corruption in China after getting an anonymous letter alleging potential compliance violations by some employees. Screenshots of the letter that circulated in China show it claims workers received kickbacks from external service providers. Adidas has already faced consumer boycotts in China and a significant hit to sales. GameStop CEO Ryan Cohen says he's focused on turning the video game retailer around by boosting profitability and avoiding the hype of the meme stock frenzy. Cohen was speaking at an annual shareholder meeting that was delayed from last week by technical issues. GameStop has struggled to pivot away from physical stores to a digital-first strategy.
Revenues without profits and prospects of future cash flows are of no value to shareholders. This means a smaller network of stores with an expanded assortment of higher value items that fit into our trade-in model. We are not here to make promises or hype things up. We're here to work.
All right, so let's take a look at how things are tracking for Toyota. We've got the stock modestly higher at the moment by about 0.5%. A reasonable year for Toyota in terms of profitability, but some questions around safety, some questions around EVs as well. So for more on this story, let's get to our global business editor, Karen Lee. So Karen, give us a sense of the context heading into today's meeting.
Yeah, well, Paul, this is a really interesting day for Toyota watchers, and I'm still getting up to speed to it on it myself, pardon the pun. But Chairman Akio Toyoda is very likely to be reelected today. That's not really in doubt. But Japan does have a widening probe of car safety certifications, and that means his approval rating is in danger of dipping from a low last year. And that's unless company leaders can address a few things that shareholders are going to be watching, and those include oversight, board independence, and shared governance. So that's the scene facing Toyota's executive board coming into the meeting today, and people are going to be watching that very, very closely.
And Paul just mentioned that Toyota has been actually doing pretty well in terms of profitability, right?
Yeah, I mean, there's been pluses and minuses for Toyota. Its shares have tumbled more than 10% this month. And we have this latest probe that's raising concerns about the wider repercussions of the safety certification investigations that have been taking place in recent weeks. But at the same time, let's look at what it's been doing over the last year. It was a blockbuster for Toyota last year. It raked in 5.4 trillion yen in the fiscal year through March. That's $34 billion. And that's the first time a Japanese company has surpassed that 5.4 trillion yen mark. And production and sales also hit record highs, and that really kept Toyota comfortably in its status as the world's top car maker for the 4th consecutive year. So there's a really interesting context coming into today's meeting, and shareholders are going to be watching this very, very closely, as are we.
Our global business editor Karen Lee there, of course, as we follow that Toyota AGM, and we're following that stock as well. We're also watching Chinese bonds after that incredible rally that we've seen in that market for the past few months. We've heard from Beijing as well, ramping up the warnings against bond bulls because that rally sent long-term yields to 2-decade lows. And if you take a look at the 30-year yield, we're really standing around the lowest levels in more than 7 weeks. And the PBOC leaving that key interest rate steady for the 10th straight month on Monday, also playing into the markets right now. We continue to see, Paul, that caution on monetary easing in China.
Yeah, and on that topic, we have seen the offshore yuan firm a little bit more broadly against the greenback. We've got higher oil, a little bit of concern about what's been going on in Europe as well. But if we take a look at S&P E-minis, they're ticking up as well. We got very, very close to seeing the S&P reach a record high for the 30th time this year. So it's very close to that as we, of course, await retail sales data out of the US. Futures for Taiwan also setting up for a very positive start, better by 1% at the moment. That is it from the Asia trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen.